Welcome. My name is Sasha Moore, and I am absolutely delighted to moderate today's Broker and Sales Acquisition webinar. The reason we're holding this event is to provide brokers with greater insights and understanding about the different sales and acquisition strategies, as well as the corresponding tax implications. So off the back of that, what we've really noticed is there's always a lot of flux going on in industry, and it's always just wise to know what your strategies can become or what opportunities you have to structure things, obviously in your best interest, should you decide to acquire a brokerage, or equally if you're considering selling it. So for today, we have two finance industry specialists with us. We have Nick Young, the Managing Director and founder of the leading trail book company, Trail Homes. Welcome, Nick.
Good morning, Sasha.
Always great to have you on board.
Thank you.
And Justin Mastores, the Managing Partner at Rees Group, who is a leading accountant and SME advisory firm. Welcome, Justin.
Good morning. Thank you.
So Nick and Justin are going to provide some fantastic insights today on the areas that can affect the sale of your brokerage, the small business concession caps that every business should be across at all times, the different ways that brokers can acquire or sell a business, and as I mentioned, the corresponding considerations, tax implications, and the merits of each option. So we love questions. We're geared to answer all of your questions. You may have heard me speaking offline just now that it's been tremendous that we've had so much engagement even before the webinar, and with brokers obviously wanting to be across it after the fact. So on that note, we will definitely share the recording of this webinar with you all afterwards in case you want to go back to a particular area. And we'll also provide Nick and Justin's details should you prefer to have an offline discussion with them. But in the meantime, use the chat function or the Q&A function, and we'll get through as many questions as possible. So, and as I said, yeah, we'll provide the details for Nick and Justin as well. So we've got a lot to cover in this session, so let's get cracking. So let's start with an overview of the factors that brokers should be across that can affect the sale of their business, which boils down to the grassroots understanding of the legal status of your brokerage. So Nick, tell us your thoughts about that.
Thanks, Sasha. So as you say, the legal status of the ownership is probably the most important starting point. So it amazes me the number of brokers who ring up and say, listen, I'd like to sell a trail book, or I'd like to sell my business, and they don't really understand actually what they own. So I'll give you an example. Many brokers are operating under a franchise type structure. So I'll give a couple of names here. There might be Aussie Home Loans, it might be Mortgage Choice, to use some of the bigger franchises around, but there's many franchise arrangements in place. Now, most franchises, effectively, you will be governed under the franchise code, and effectively the franchisor will be able to dictate and will dictate just how you can or cannot sell your business. Typically, it must be sold to somebody who wants to take on your franchise. So that's the first thing, is to recognise whether you are operating in a franchise or not. The other one is, and this is particularly important with regards to your trail book, but also the ownership of clients, is whether your agreement, well, first of all, who your agreement is with. So again, I'll get many brokers ringing me up saying I've got an agreement, and I'll again use aggregator names here, with AFG or Connective or Loan Market Group or whomever this large aggregator might be. But when you actually look very carefully at it, you'll find that they actually have an agreement with a sub-aggregator. Now, that's really important because it means they actually don't have an agreement with Connective. They've got it with that sub-aggregator. And then the final bit is to actually read inside the agreement to see, in the case of a sale, whether they, a bit like the franchise, whether the person who that they have the contract with effectively recognise their ownership of the trail book, and similarly the ownership of the similarly the ownership of the clients. Without that, effectively you've got nothing to sell. And I've witnessed it at first hand that after many years of working a broker has found out for the first time that their agreement actually has that if they stop working or terminate the agreement, they lose their trail, they don't have any rights to the clients, etc., etc. So make sure you first of all have a copy of your agreement and you properly understand it.
Yeah, and I concur, Nick. I cannot imagine being a broker and having the assumption that you own your business, the assumption you own your trail, the assumption you own your client, because that as a business owner would be as you would expect. But yeah, as Nick said, when I've spoken with Nick about this for many, many years, and I always think that, you know, as a business owner, it would be so easy to sign something with the superficial understanding of what you're signing without the really granular understanding. So anyone that I even speak to about coming into industry, it's exactly that question. What happens if you leave? If you choose to go to a different aggregator, you choose to leave the industry, what happens then? So as Nick said, who does your business actually own? Who owns your business? And then not only the actual physical business and the trail, but also the goodwill that comes with that. So I 100% concur, Nick. And if there's nothing else that's taken from this webinar, I would really hope that every broker off the back of this today gets their contract and just really understands those basic questions to make sure that you are in a position of empowerment in the future and that you do actually know the ducks you have lined up that you can actually play with.
Indeed.
So moving on, Justin, I know you love talking all things tax and particularly concessions. And as a business owner, I also really love the discussion of tax concessions. So Justin, if you can just do a recap, what should every business be across independently of a specific sale or acquisition strategy at the moment?
Thanks, Sasha. Well, I think what's really important is just understanding your structure of your business. So when you started out, whether you've restructured along the way, whether you've stayed in the same structure, because whether you're structured in a company or a trust, that could have a marked impact on your capital gains tax and your capital gains tax position upon the sale of your business. Conversely, you know, you should be taking advice if you are setting up your business or you've just set up your business and potentially just set up a company and not really spoken to anyone about it. I think getting some advice on whether or not a company is the best structure for you, not necessarily today, but taking into consideration when you potentially may be looking to exit the book or business along the way. So small business concessions, there are a number to take into consideration. By that, we mean the ATO has an allowance for capital gains tax. So instead of just paying capital gains tax on the full amount of the gain that you make when you sell your book or your business or entity at the time, there's a number of concessions for small businesses. A small business essentially needs to meet some criteria around the assets associated with you as the principal, and whether or not your net assets and associated entities are less than 6 million. The turnover of the business needs to be less than a couple of million as well. But there are concessions as a small business concession for 50%. And I'll run through an example in a moment, but where you can essentially reduce your capital gain by half. There's also some other concessions relating to retirement. So you might be sitting here at the moment thinking, well, I'm getting close within the next couple of years. I may want to speak to Nick and talk about me retiring and selling my book. Well, if that's the case, there's actually, if you've been continuously running that business, there's a retirement exemption for capital gains tax, which could eliminate all of your capital gain. So that's a really important one to understand. And the other one for old blokes like me that have been running businesses for more than 15 years, that if you've been continuously running your business and your brokerage for more than 15 years in the same structure, there's some considerations to take into account. But again, there's an exemption for a 15-year exemption. So you might not need to retire, but you might be able to alleviate the majority of your capital gains tax with that as well. So maybe a small example there is that if I had a business that was a capital gain of $1 million when I sold my book of $1 million, and I qualified for the small business exemption that I mentioned before, which was that 50% exemption, I can reduce that $1 million gain to $500,000. potentially the structure we were talking about before, if I'm structured in a company or a trust, if I'm structured through a trust, and ultimately that could be a discretionary trust or a unit trust, if I've got other partners involved, I could be able to avail myself of an additional 50% reduction in my capital gain. So all of a sudden, my $1 million gain has been halved and then halved again. So I've got a $250,000 gain to deal with from a taxable point of view. And then there are, with, again, your accountant's advice or the right advice, some superannuation concessions where if I made that contribution into super, I can absolutely alleviate the total gain and retain all of that cash in tax-effective environments like superannuation, and also without paying any CGT in that example. So that's really important to take into consideration.
And I think you raised so many interesting points and, again, challenging assumptions. And again, from a business owner's perspective, my absolute advice would be to any broker is to get your contract, understand what that means, and then sit down with your accountant and say, and do some mapping. So it doesn't really, from my perspective, it doesn't matter if you're 30, 40 or 50, you want to know exactly where you're at. And, you know, and as Nick often speaks about, that succession planning from the beginning. So for me, it would be advantageous if you're, say, a 30-year-old broker, you want to retire at, call it 50, 55, whatever, you have those succession planning principles, and in conjunction, understanding the tax concessions, how you can use super, et cetera, et cetera. So you're not only making a wise call if you are going to exit the industry, but equally where you stand along the way, and if you're looking to acquire a brokerage as well, what those conversations look like. So I think it's really important that, obviously, with this conversation, we do want to make sure that we're talking about if you are going to sell your brokerage. But one of the things that I know Nick's seen a lot of is actually brokers acquiring other brokerages. So I guess there's sort of two lenses with that. I have had a question come in from Liani, Nick, and I think this is probably an offline discussion for you. She's asked, just want to know if any new brokerage into the industry can still buy a brokerage through Trail Homes.
We're not a broker of mortgage broking businesses, but talk to me. If you're looking to buy a business or a mortgage broking trail book, talk to your aggregator, talk to me, talk to everybody. Just get out there and make it known. PD days, MFAA, you know, any of these sorts of functions you go to, just talk to people that are in your local area, and particularly in this, you know, Justin will love me saying this, talk to old farts. Because old farts like Justin and I, we are thinking constantly about what's going to happen when we retire. So if you make it known to the older people in the room that you're a buyer, you might be amazed what comes out of those discussions.
Yeah, I think that's really sound advice. And also, I like also within the broking industry, there seems to be an evolution in terms of how business is done. So the classic, you know, you start as a broker, build up your business, you sell it, etc. That seems to be morphing, where I'm seeing more and more brokers collaborating either officially or unofficially. As that question just suggested, you know, how can you escalate your growth without going through the traditional patterns and pathways and so forth? So I think all of those questions are great. And to Nick's point, the more industry events, aggregator events and so forth that you're at, and the more questions you ask and the more you're known, then those types of opportunities, aligned opportunities, will actually start to present.
Sasha, just on structures, to that point of the acquisition. So obviously getting advice on the structures really important to Liani's query before, but also too, you might be merging, and Nick was saying there about an acquisition or a merge, and there are again, we're not going to get into it today, but there's tax concessions to say, well, if my business is worth $500,000 and I'm merging with another business of $500,000, I don't actually have to pay tax on the merger. It's not until the end when I sell it. So sitting down and understanding the best structure and how that's going to affect you today or, you know, next month when you're actually doing it is really important, rather than just going gung-ho with the acquisition.
Yeah, absolutely. It's about having your ducks in the row to start with, right? So let's move on in terms of the different ways a broker can acquire a business. So Nick, we'll go back to you. So let's start with, because I know there are sort of a couple of core ways. Why don't we go through the different ways a broker can acquire or sell a business? And Justin, when Nick goes through it, I'd love to hear your corresponding considerations for each of those choices. So really the point of going through these sort of 4 or 5 areas is not to say this is what you should do, but it's 100% to say these are your options. So when you're considering your career mapping, when you're considering your contract, when you're considering what assets you actually have ownership to, and should you consider buying or selling, you then have the basic structures to then go to a Nick or a Justin or whomever else to ask the questions to place you in the most solid standing. So Nick, over to you. We'll start with the 2 aspects, perhaps if you can start with, in terms of the business and the goodwill.
Yeah, so I look at any mortgage broking business as really having 2 assets. One is the trail book, which is an easily defined, very tangible asset. You get a lovely commission statement every month, so you can see literally down to the last cent how much trail it generated. The other asset is an intangible asset, and it's the goodwill. Now, the goodwill is, there's many definitions for goodwill, but the one I quite like in a mortgage broking business is it's the right to answer the telephone tomorrow. Now, the right to answer the telephone tomorrow when it rings, if it rings, can be a very valuable asset, but it might be worth a lot. It might be worth nothing. And that's what makes the goodwill such a difficult asset to trade and value. And a lot of probably what we're going to cover over the next half an hour or so is trying to actually maximise the value of the goodwill. And it's a really tricky and crafty game. But starting with the trail book, the easy bit, we'll buy trail books every day of the week. And literally that's what we do at Trail Homes, is just buy trail books. Now, typically they trade from about 1.5 to 2 times. They were historically trading a little bit more than that. But as any mortgage broker in the room will attest to, over the last year or so, we've seen a lot of refinance going. So the runoff in trail books has been historically very high, which means the multiples are a little bit down at the moment. We may be about to move into a period where the runoff rates start to decrease again, which means the multiples might start to increase. But at this particular moment, the maximum we're paying is about 2 times. So that's just to buy the trail book and the first asset. And that can be used to, we're buying trail books, as I say all the time, just to, for people who might wanting to, I flippantly say, whether they're buying a speedboat or investing in their business or using it, the funds to buy another business, that's their call. But that's the first asset. The goodwill, we might talk about as the next stage.
No problem at all. And I think also, Nick, it might be worth just touching on whether there is an option to sell a portion of a trail or whether it needs to be completed.
Yeah, no, that's a good point, Sasha. So you don't have to sell your whole trail book. So typically, when we buy a trail book, we look to buy an amount in excess of $1,000 a month. But sometime we'll have a broker who will say, okay, I'm getting 5,000, 10,000 a month, and they might look to sell half, a third, 2/3 of the book. And we're very amenable to that.
Okay, and just on the notion of trail book sales, I've actually had 2 questions come in which are quite similar, one from Sarah and one from Norman, about whether trail books can be bought between different aggregators. So if you're in I can actually give an example. If you're an aggregator A, can you buy the loan book from an alternative aggregator?
Yeah, good question. And the quick answer is it depends. There will always be rules and regulations or requirements that the different aggregators will impose. Some aggregators, it's an outright no, that you can only buy one of their trail books if you become a broker with that aggregator. Some aggregators are a little bit more relaxed in that you can aggregate through aggregator B, and buy from aggregator A, assuming aggregator A is willing to sell, so or condone the sale. So it depends.
Yeah, and I guess that also comes back to one of the core the core questions when you are assessing an aggregator or you are reviewing your contract. What does it actually say about this specifically? And if you don't have the clarity, ask the question and be very, very clear about the answer. But then also I would suggest making sure that you've got have that discussion in writing, so you do have that clarity to know that if you are going to pursue that path, that path is actually open to you.
Yeah, have it in your agreement.
Yeah. Pardon?
Have it in your agreement.
Precisely. So, Justin, from your perspective, what are your comments about that particular structure from a tax or a business structure perspective?
Yeah, I think the sale of a loan book or part of a loan book, again, coming back to that structure, just using the simple example of owning a book in a company, you sell the book, you receive an amount, obviously depending upon the contract and the structure of the contract in relation to the runoff, which we'll talk about later, you're essentially paying 25% tax in a company. And if the funds then end up in the company, you need advice on how to get the money out, because if you want to reinvest in something else, as Nick was saying before, well, then you need to get the advice because it's sort of the company's money. So coming back to my first point is, the structure of the ownership of your book is important. And if you are acquiring, the structure of how you acquire the new book, it might not be acquiring from the existing entity. You might set up a special purpose company to buy the book, or you might want to merge them together. But again, taking the advice, because the tax and asset protection considerations are important to take into account.
Let me actually ask you a curly question, because I know that just my observation is that businesses are becoming a lot more astute with super and also considering other structures for super. So, Nick and or Justin, have you seen the selling of the trail book or any aspects of this discussion directed into super? And what triggered me to ask that is, if you are setting up the trail in a SMSF structure, that asset protection and so forth, is that something that a broker could consider?
Well, perhaps I'll start and then go to Justin. Typically, small business people are very underfunded in super. So John Howard was the one who actually, and Peter Costello, when they were in power, spotted this and gave these great tax breaks that Justin's touched on, so that business people, particularly at the end of their careers, could take a lump sum and put it into super. It's one of the last lurks, because at the moment they're just putting increasing numbers of restrictions on bulk transfers into super. This one is completely uncapped. I mean, you can literally put millions potentially into your super fund. It's quite extraordinary, really. So yes, we are seeing it, and we're also seeing it from people who are not necessarily actually even retiring. They're just taking the opportunity to move some money into super. So that's certainly we do see it. Justin.
Yeah, so I wouldn't necessarily recommend that someone buy a trail book in their superannuation fund. And one of the main reasons for that is, well, the allowance of the SIS Act for you to do that. But also, super legislation probably changes. It probably changes every other year. So what the rules now won't be the rules in 2 or 3 years' time. So I think what's important is having a diversity of investment and using superannuation, as Nick was saying, to potentially get millions to fund up your super fund. Using the concessions I was talking about before and other means as well is probably a more astute way of looking at a transaction like we've been talking about.
Can I just underline this bit from Justin, because I do get discussions or calls about this. You cannot operate a business outside of your super fund. Inside your super fund. So even though you might have a lot of money in your super fund and you're thinking, I'll go and buy a trail book and then I can farm it for the clients. No, you can't.
Correct.
Yeah.
Okay, great. Thank you. Well, let's move on to the next section. So guaranteed rate of runoff. So Nick, talk us through this.
So this is an innovation that we've brought to the market this year. So over the years, I've had In fact, it's almost every single trail book I buy. And you got to love people, but every person that I look to buy a trail book from, every single one of them tries to tell me that their trail book is better than the average. I've got this really great trail book, and and therefore you should pay more for it. Unfortunately, I don't. I actually think everybody's trail book is broadly the same. But over the years, and perhaps I'm a bit slow, but I thought, wait a tick. What about if the broker who believes their trail book is so good, what if they were actually willing to guarantee the rate of runoff for an agreed period of time? So an agreed rate of runoff over an agreed period of time. If they were willing to do that, I could actually pay more, and potentially I could pay significantly more. So for an example, if the broker was willing to say, okay, the rate of runoff will be 10% for 12 months, then potentially I'd be willing to pay 2.4 times. So if there's no guarantees, 2 times, but if you're willing to guarantee a 10% runoff for the first 12 months, then I'd pay 2.4. And thereafter, there's the guarantee drops and it just runs all off at the normal rates. Or we can even go further. If you're willing to guarantee 0 runoff for the first 2 years, then potentially I'll pay 3 times. The third year and thereafter, guarantee drops and it just runs off at its normal rate.
Sorry, Nick, can I just interrupt for 1 second? I have just had a few questions coming in asking to clarify what is meant by runoff.
Okay, so if let's just say we're talking about a trail book that's generating $10,000 a month. So effectively no runoff means that I'm going to continue to get $10,000 a month. So broadly what that means is that day one, the selling broker will actually assign over some extra loans, what we call the buffer. So there's the original book of 10,000, then we have a buffer on top of it. The second month, so we do it, the agreement's $10,000 a month, 0 runoff, 2 years. In the second month, we get, let's say, $11,500 worth of trail in. We immediately transfer back as cash $1,500 back to the selling broker's bank account. So effectively leaving us with that agreed $10,000. We play forward, and at the end of the 2 years, we're looking for that $10,000 still to be there. And if there's any excess trail, we then transfer that excess trail back to the selling broker. But effectively what will typically happen during that 2 years is that the broker will refinance loans. They will, if you like, drop off, but they then might have to reassign in new loans to effectively top up the book that they're guaranteeing.
Okay, thank you. So Justin, from your perspective, do you have any additional comments to that guaranteed structure opposed to the portion or whole trail book sale without the guarantee component?
Yeah, I think one of the simple terms of contracts, contract law and tax is the date you sign a contract is the date that triggers the capital gains event or the taxable event. So just got to keep that into consideration, especially, coming up to the end of the financial year. If a contract is signed on the 1st of July, it's actually in the 25 financial year this year, not the 24 financial year. So that's the first point. And the second point I just wanted to make is, again, with the right advice, given the guaranteed rate of runoff, you might decide that you have a guaranteed rate of runoff, but you might decide to take and structure your contract to take a decent amount up front, but also to then, based on performance, an amount in 12 months' time. And by doing that, and I'm not saying it's 50-50, but it might be 80-20 or something like that, depending upon the runoff, you might be able to defer some of your tax or tax considerations into a future financial year rather than doing it all in this financial year, as an example.
Yeah, and I think that's, again, a really important point. You only know what you know. So really the takeaway from that would be, before you make any decision, even if you're contemplating it, run it past your accountant first. Does this serve me? How can it serve me best? And how can I structure it, as you were saying, Justin, to sign the contract in a way that's going to place you in a tax advantageous position? So we might move on and then we'll go to a few questions because I'm getting loads coming in, which I want to see if we can manage to get through all of them. So the third structure, Nick, can you talk through employee share scheme and revenue sharing?
Okay, so this is sort of how do I get the maximum multiple for my business? So the worst multiple would be to say, okay, I'm just going to sell my trail book and I'm going to close my shop up and all my clients can go and get stuffed. That'll give you the worst result. Quick and easy to facilitate. I can probably organise that for you within a couple of weeks to be all done. Next step up to actually try and focus in on this goodwill and try and maximise the value of it. Now, the maximisation of the goodwill all gets down to the transition and try to make the transition from the person who originally established the business to effectively what we might call the new owner as easy and as smooth as possible. And to do it in a way that really considers the clients and make the change as least traumatic and as least noticeable as possible. Now, I'll dip into Justin's world here. Accountants are very good at this, and you'll often see an accounting firm or two accounting firms, you might have Justin's accounting and Nick's accounting, and there'll be a merger between Justin's accounting and Nick's accounting, and we'll end up with effectively a new firm, Justin and Nick's accounting. We'll then play forward a couple of years, and then we'll have Justin incorporating Nick's accountants, and then we then might play forward a couple more years, and it'll be back to just Justin accounting again, and effectively Nick's accounting's dropped out the side door. Now, of course, right from the word go, it had been worked out that Justin was going to buy Nick's business. So it's a way of being able to do it by way of merger. And we might talk about that a little bit more. The other way of doing it is through an employee share scheme where you effectively sell down to your staff. So we might have Nick's accounting, and effectively then we're going to set up an employee share scheme, or Nick's mortgage broking, and Justin, being the young enterprising employee who's doing really well, effectively is going to be given the opportunity to buy shares in the business. Now, this is the way that you probably get the most maximum value out of your business, is to effectively sell it down to your staff. Two big considerations. First one is the staff have got to be capable and strong, and that's not something that's brought about quickly and easily. You've got to actually start employing people, not because they'll be a good assistant or whatever, but because they're as good as you and potentially better than you. And they're people that can actually take on and run your business going forward. So it's a change of mindset as to who you're hiring. The other bit is it requires time. So I mentioned before about the quick and sale of the business, 3 weeks, close the shop, we're all done, gone. To actually start and hiring these good staff, bringing them on, setting up employee share schemes and start selling down the business to them, that's going to take years and a lot of planning. Now, the mechanism of employee share scheme, I might throw over to you, Justin, because this is probably your more your area of expertise. But what's the tax benefits of an employee share scheme?
Yeah, so we'll exclude large corporates. So, if you work for Seek and you're on an employee share scheme, it's very different to obviously working in a private enterprise and having an employee share scheme. And in this particular case, really what we're talking about is a succession plan, as you're saying, Nick, to maximize the value of the business, but it also allows for transition over time. And because of that, and it might be a percentage of a year that someone acquires or a group of people acquire into your book or your business to maintain that goodwill, it then means the contract can be structured again over potentially not just 1 or 2 years, Sasha, like we were talking before, but 3, 4, or 5 years. And an example of that, whilst it's different, it's not a mortgage book, is when I first bought into Rees Group, I bought in 5% lots over 3 years. So if we think about the tax considerations of a broker doing the same thing, the person who's selling out only got the taxable event each year for 3 years. So this sort of employee share scheme versus you gifting shares as an ongoing business is a different consideration. But in relation to what we're talking about, that's what I think applies.
Okay, great. Did you have anything else you'd like to add to that, Nick?
And potentially, and that's might be a bit early to introduce this, but none of these things are exclusive in the sense that I do that or this. You can actually do a bit of both. So you can effectively say, okay, we're going to sell out some of the trail book on a guaranteed return basis. We're also going to do an employee share scheme. And effectively, the combination of the two will enable me to extract a significant amount of money out of the business. So bear in mind, you can mix and match these different options as we're going through.
I think that's actually really an important point, because I think often just it's human nature to think it's A or B or C. So I think, if I was a broker, that's the beauty of this. By actually speaking with specialists and speaking with industry experts, you can actually custom an arrangement, assuming that you're permitted to do so within your contract and so forth, and have a bit of it's almost like a wealth or an advisory plan in place that then really tailors to your business goals as well as your personal goals. I might just throw to a few questions before we get to the final section of structuring. So, Justin, this one's for you. It's from Julia, who's asked if GST payable with the trail book purchase, whether GST is payable with the trail book purchase, or whether it's an ongoing concern. Yes, so how GST is correlated with a trail book purchase.
So the sale of a trail book is essentially classified in most cases as a going concern and as a business. So GST would be allowed for in the contract, but not necessarily paid, because the fact that, as Nick was saying before, there's a guarantee potentially in place and the clients continue on. So it gets detailed by the lawyers, but essentially on settlement, there wouldn't be a GST payable because of the going concern element.
Okay, great. Thank you. Nick, I've got one to throw to you. We've been asked, so if a book is sold, but the broker is guaranteeing runoff, does that mean that they are still running the business for that period of time?
Very much so. So they're providing the guarantee. So it's very much on the assumption that they or somebody else, whoever is running the business, controlling the clients, controlling the trail book effectively, they're in the business, and it's a critical part that they're in there and operating.
And I guess sort of the reverse lens of a guaranteed runoff to that point is guaranteed business investment. So you're guaranteeing your business investment to then limit the runoff. So ensuring that your business is robust is, from what I understand, the key component of that structure. Yeah, so if you
sort of step back a little bit, a mature mortgage broking business, so if we think of I don't know whether most people in the room are aware of this or not, but a mature mortgage broking business, about half the income comes from the upfront commission and the other half comes from the trail commission. So if the business is growing, you'll find that the upfronts are actually greater than the trailing commissions, and obviously the trail book then is growing. Conversely, if it's in decline, it'll be the other way around. So if you think about somebody who says, okay, I want to grow my business and I need a capital injection. I might, for instance, be taking over another business. How can I fund this? I will sell a chunk of my trail book on guaranteed return, let's just say 3 times, and I'll guarantee there'll be no runoff for the next 3 years. So effectively, yes, some of the growth will come from refinancing old clients, but there'll also be a lot of growth from new clients coming into the business. So if you think about what's going to happen in the background here, as the clients drop off the book that's been sold to trail homes, effectively they will be refinanced by me. I'll get to keep the upfront commissions on those loans. The trails effectively will be then transferred across to trail homes to effectively fulfill this guarantee, only for the first 2 years. Then after that, I get to keep the upfronts and trails on everything. So it's effectively putting in place a financing mechanism for me to be able to grow my business. So yes, I manage the clients. The clients don't know anything about this really. In fact, they don't know anything about how it's all being financed. But it enables me to use the capital of trail homes to go out and buy a business, let's say 3 times, and fund the acquisition.
that actually lends me to another sort of related question that's come in from Paul. Does the guarantee runoff option work if the broker is selling the business and the trail and exiting the industry? So it would be more considered as a growth option, would you? If we're
Potentially, but
looking at.
yeah, I've done a deal recently where the broker is looking at selling. They have a very, very large trail book, so large that it's probably too big for any one organisation to be able to buy it. So effectively, they've sold a chunk of it at 3 times to effectively get the size of the business down. It's a much more digestible chunk for somebody to come along and buy. And they will be able to sell that business, I suspect, on a very high multiple, because effectively the upfronts or the amount of turnover in that business is way larger than the trail book, so the remaining trail book. So they'll be able to get a good price for that. We're often approached by sellers, and we can work with them, because invariably if there's a seller, there's got to be a buyer. So, in order to get the deal across the line on behalf of the seller, let's talk to a buyer and see if we can't help them potentially finance the acquisition. So that's sort of one always goes without the other, Sasha.
Indeed. So,
just
yeah, go ahead, Justin.
Yeah, just a comment about that question. So logically, if you are exiting the industry and selling your book, as Nick was saying, everyone thinks their book is different to everyone else's, but the guaranteed rate of runoff method doesn't really logically make sense if you're leaving, because you can't then manage the relationships, and you can't really guarantee. You can only hope that the rate of runoff doesn't increase along the way. So I think, to Nick's point, you might be structuring part of the sale as a lump, and then part as a guaranteed rate of runoff. But you just want to, again, I think, talking to people, Nick, your point there, just about talking to everyone, peers, obviously advisors, lawyers, all those sorts of things. I think just to get ideas is really important. People like Nick as well, and those in the industry, it would be a good thing to do if you're considering this sort of stage.
Yeah, and just to clarify there, and Justin's point is right, but the seller can't necessarily provide the guarantee in that situation, but the buyer might. So it's where we can flip it around to the other side of the transaction.
Mm-hmm. Okay, great. Thank you. And Nick, one more quick question, and then we'll move on to our final area. I've had a question come in from Susie, whether the family can sell the trail of deceased broker.
Subject to the agreement with the aggregator, yes, there's absolutely no issue with that. We've been involved in many of those over the years.
Okay, perfect. All right, well, we'll get back to some more questions shortly, but I want to make sure that we have time to really cover the last area in terms of sale and acquisition, which is mergers and acquisitions. So, Nick, let's start with you.
So just sort of run that question by me again. I'm still thinking. Sorry, I've caught it.
No, you're still in guaranteed runoff mind.
I was actually in the mind of deceased estates, to be honest.
Oh, okay, fair enough, fair enough. Well, I mean, I guess it makes sense though, doesn't it, in terms of when you are considering your will and estate planning, your business and your brokerage, your trail, etc., is an asset. So, what happens in the instance of death in that situation? So I would expect that it is actually something that the industry would be thinking of quite prevalently.
Yeah, and it's often can be a bit tragic, and it can be a bit sudden. The thing about deceased estates is it's much harder to obviously get a good value on the goodwill, because clearly the broker who put it together is gone. That's it often comes down as to the value of a trail book, which is a bit sad, but that's what happens.
Yeah, fair enough.
Point about wills, maybe just because I think, well, firstly, we know there's quite a few hundred people who have registered for today's webinar. I'm not a lawyer, but I can guarantee you 25% of the people listening today have not updated their will or not actually checked their will in the last 5 years. So you need to write that one down and take that away. And also, just because we're talking about selling trail books from a deceased estate, you need to make sure that the executor of your will is someone who understands what's happening. So it's fine to have your spouse But in my case, I've got a friend who's quite, business astute, if you like. So he could be involved if something happened to me, and if I was a broker, I was selling my book. In this case, it would be my business. But I think that's really important to assess that. We're talking about checking agreements with aggregators. I think you need to make a note about checking your wills and who your executors are of your will as well.
Good point. Good point.
All right, thank you. Well, let's move into mergers and acquisitions as the final and possibly the most obvious way to acquire or sell a business. And sort of what I was alluding to before, I've just noticed that there are a lot of formal and informal collaborations with brokers, and the business does seem to be, or that type of structure does seem to be emerging more so. Justin, we might actually start with you in terms of, if we look at an M&A, what are the corresponding implications from a tax perspective?
Yeah, okay. So I was saying before, so let's talk about mergers. So I think with mergers, the important thing is, like we're for example, looking at an acquisition at the moment, but we're going to be obviously telling the world of accounting that it's a merger of the businesses. But it's the same with broking business, and trouble is get the structures right before you actually enter into the agreement. So if there's ancillary companies sitting around, you need to clean up your balance sheets and actually get the businesses right for the merger. And then obviously the valuation, talking to people like Nick and others about the valuation of each book. If there's more of a commercial bent in one part of the book and more of a residential on the other side, well, is the valuation the same, or potentially depending upon the mix of clients. Also too, with mergers, like brokers often have referral agreements. So it's something that you don't think about potentially, but what are your other referral agreements with accountants or other people in your business people in your network, and will they affect the potential sale of your business? Or do you need to clean up those arrangements? You could have a joint venture sitting off to the side, for example, that might be a little bit messy, that you might need to either buy the other party out or sell that off before you actually look to merge. And the main thing about the acquisition or sale, as we were saying before, the M&A side of things, is this the timing and structure of the deal. So we've touched on the capital gains tax concessions. We've touched on if you're selling a business and it's sitting within a company, you're paying 25% tax. There's not a lot of flexibility, and then getting the money out of the company is an issue. So a merger is and we did one recently, just at the end of last year, is the merger of some broking businesses together is a fantastic time to get the structure right for the ultimate sale at the end, because you might not be right. You might have one company, one trust, and some guy in as a sole trader, and you're bringing everyone together. Well, now's the time to actually get it right and get the structure correct, because you could be saving hundreds of thousands, if not millions, at the end by doing it correctly now.
And actually, can I just also interject for a minute, because Andrew has put through a question which has prompted me. First of all, he says, well said to you both. So in terms of a partnership, looking to have a buy-sell agreement, and I know both Nick and Justin, we've had extensive discussions about this. If you do have a partnership with another broker right now, whether or not that partnership does serve you. So in terms of then maybe perhaps Justin, can we just divert very quickly? If you and I are in a brokerage and we've just sort of got a back of the envelope sort of loose agreement with us, and I want to go off and do my own thing and so on and so forth, how would you suggest from a best practice perspective, even if the partners are in a great professional marriage, how would you suggest would be best practice to renegotiate that agreement to make sure it serves both parties equally?
Yeah. So firstly, a partnership is generally not the best structure, a traditional partnership, to actually run a business out of. And there are considerations around tax, because it just flows straight through, and also considerations about asset protection. So that's something to consider, is just assessing the structure of the partnership. But most importantly, I think we did a series. I think it was, start with the end in mind. Was we had a little ebook years ago, such that we all three of us worked on together. But it's about thinking now not necessarily the worst case, but what does the end look like? So just to the question before, you need to actually have an agreement in place. And if it's a company, it's a shareholders agreement about what happens if something, someone wants to get out, and what the valuation, is. And depending upon the timing, you might need to bring a valuer in or someone like Nick to actually look at that element of your business. But actually at the beginning, getting that in place, or even if you're partway through, and as you said, you have a back of the envelope handshake agreement, getting it structured right now where you actually got a buy-sell agreement in place or a shareholders agreement, and they're not overly expensive if you use the right lawyer who understands the industry.
Okay, thank you so much for that, Justin. I will let you continue though, going back onto script about the tax implications for the mergers and acquisitions. So did you have any further comments that you'd like to share about that?
Yeah, so the only other thing I was going to mention, we talked about obviously structure, timing, but also to the structure of the payment. So whether there's an earn-out for staying in the business or a guaranteed runoff, the structure of a payment over time potentially might be a great way to minimise the tax as well. So just from a sale point of view, an acquisition, generally speaking, you'd want to, from a tax point of view, have the contract consolidated to all within one period of time. But if you were selling out, you might get some benefit, again, with the right advice about having a contract and some earn-out points over a couple of years to spread the tax liability or the potential capital gains tax.
Okay, great, thank you. And Nick, from your perspective, do you have any further comments?
Yeah, Sasha. So one of and this is particularly pertinent to mortgage broking businesses when they merge, it's the obvious question, but often not thought about, whether the trail books should be included or not included. So I've seen both being done. It's sort of like a 50-50 sort of thing as to Justin and Nick merge their businesses, but are the trail books going to be included? Or do I keep mine and Justin keeps his and we just effectively merge the goodwill going forward? If the trail books are left out, that then also opens up the opportunity that I might choose to sell my trail book. Justin wants to keep his trail book. So we was talking earlier about mixing and matching different solutions and different options to come up with the optimal result for the people involved.
Yeah, and it's an interesting point because I expect you as a broker, you would want to have enough flexibility, but you would equally want to have enough set in concrete that you're not then exposed. So as we've discussed, have the conversations and have them early to make sure that you are in a position that you do have actual choice. So let's move on to a few more final questions before we wrap. I've got a question, Justin, that I'm going to direct to you. Are there any tax offsets if you were to sell, say, 30% of your business?
Yeah, so the initial part of the webinar before we were talking about the small business tax concession. So if you only sell part, say 30% of your business, you can still avail yourself to the concessions, the small business concessions, and also the concessions around tipping funds into superannuation. We had a broker sell a part of their business recently, and I think it was about a $400,000 amount. And they're going to put part of that money into superannuation. It means that they essentially negate the capital gains tax on the whole on the part sale of their trail book. So absolutely, yes.
Okay, thank you. And staying with you, Justin, we've had a question coming from Quinto who's asked, does the 15-year CGT concession rule start again after a merger?
Depending upon the percentage of the merger, so if it's a 50-50 merger, 50% is still potentially considered a controlling interest. It may not, but if you were to sell, if you were to merge and you were 30% and the other merger party was 70%, it would start again because you need to have this controlling or 50% interest, and that needs to, and there's some obviously detail around this that I won't bore everyone about today, but there needs to be that continuity and controlling ownership for that continuous 15 years.
Thank you. Nick, I'm going to go to you with a question from Peter. If I sell my book or part of it, who owns the clients and how does that work?
Can be an either or. with trail homes, the selling broker keeps the clients. So we are just getting the right to receive the trail off an agreed group of loans for however long those loans last for. And over time, we expect they will all be repaid, whether it's by refinance or whether they just repay down to zero or get discharged down to zero. The book that trail homes buys will literally go to zero and we'll end up with nothing. And if the broker is still in the industry and still doing what they're doing, potentially they've refinanced them all and effectively they've recreated the trail book back on their side. Just to properly sort of underline that, I have a group of brokers who like to sell their trail books every 6 to 12 months. I think the record is, I think I'm up to a broker who's sold his book 12 times now. And I somewhat chuckle when I buy the latest book from him. There's invariably some old clients that dropped off. In fact, there's often quite a lot of old clients that dropped off previous books that he sold and, of course, have been refinanced into the new books. That's quite all right. That's part of the deal. So that's how we do it. Other occasions, it's very much that the clients go with the trail book, and it's important that we get this clear. When you are buying, are you just buying a trail book or are you effectively buying a business? And a lot of people use the term, I'm going to buy a trail book, but they're actually looking to buy a mortgage broking business. And conversely, you'll get other people out there saying, I'm looking to sell all or part of my trail book, and it is just the trail book, it's not the client. So whether you're a buyer or seller, make sure that the person on the other side of the table clearly understands what's actually being offered.
Great, thank you. We'll go to one more question in a moment, but I have had a question come in from Warren, who is in Brisbane. He is looking for any experienced lawyers for the sale of trail books in Brisbane, with the plan of him retiring in 5 years, and also his 2 kids are finance brokers. So Warren, I'd absolutely suggest you have a chat with Nick about that, but I thought I would just open that to the group because we've got a few hundred brokers in this session. So if any of you are able to provide any insights for Nick, beg pardon, for Warren, please just use the chat function to let him know of any more recommendations.
Can I just quickly hop in? And yeah. This is just nothing against lawyers, but to begin with, I actually try and keep the lawyers out of the discussion. Just talk to your accountant. That's really important. Get an understanding. Talk to the buyer, or if you're on the other side, you're the seller. Get the rudimentary deal in place. And once you've got what I call heads of agreement, bullet points, then go and get the lawyers involved. But if you get the lawyers involved too early, there's just so many ifs and buts. And meanwhile, the lawyers ticking away at a few $100s an hour, and it can get out.
It may go around in circles rather than getting to a resolution. It's we've seen, both Nick and I have seen that a number of times. That's really good advice, Nick.
Just try and get as far as you can. At the end, you will need a lawyer, but just try and get as much as you can first.
Okay, Justin, I know that you want to go back to M&As, so I'll throw to you in a moment, but I've had George just really request that we answer his question. So with the 15-year exemption for the sale of an asset, does the ATO look into where the loans came to be part of an asset portfolio that's being sold? For example, the company business started 15 years prior and steadily grows. Are all loans treated the same?
Yeah, so what happens, George, is, and again, you need to take advice on this, but there's a definition of an asset called an active asset. So if the book has grown as part of an overall business, generally speaking, that business and the book which forms part of your broking business would be an active asset. So it doesn't matter when it first, as long as it was more than 15 years ago, it doesn't matter how many loans have been added along the way. The nature of the income and the nature of the business needs to stay the same. And then it needs to be categorized as an active asset. So the ATO won't actually look at it as such. It's self-assessment in that your accountant and yourself have to sit down and work out, and he has to abide by the legislation to work out whether you comply with the terms of an active asset. But generally speaking, a mortgage business and the trail book within the business would classify as an active asset for the 15-year exemption rule.
Fantastic. Thank you, Justin. And what did you want to also mention about M&As?
Just back to Nick's point. So I forgot to mention before when I was talking to everyone about sort of M&As and other considerations. Nick's example of the broker who sold the business many times is there is one other thing to think of in relation to a small business concession. So you can sell a book or part of your book, and you might not necessarily put that money into superannuation, but you might have an idea or an element of the industry that you want to get into. It could be more online, it could be more commercial. You can actually, it's called CGT, capital gains tax rollover relief. So you might take your $500,000 that you got from Nick from selling your book, and you can roll it over and reinvest into a new business within a 2-year period. And what it does is it rolls over any tax consideration of the capital gains tax, and it rolls it over into the new business. And it's not until you sell that new business it's when you actually pay the actual tax. So I think that that's an important one as well, Sash, just as you move around a little there. So yeah, hopefully that that's something to consider too when people are selling out part of a business, to take that into consideration.
Just while Sasha's getting settled, I might, just as we're getting towards the end here, as a quick plug, as well as running trail homes, we've also recently set up a new business called mortgage broker appraisals. So often a precursor to either buying a business or selling a business is to have somebody run their eyes over it and come up with the value of it. So if anybody's interested in having their business or a prospective business valued, don't hesitate to give me a call.
And yeah,
Fantastic.
like Nick on structures too. After the last webinar, we had a couple of people reach out just on the whole structuring thing. So happy to help.
Well, thank you so much, gents. And thank you so much to everyone who's attended today's session and fired through so many fantastic questions. Anything that we haven't gotten through today, we will endeavour to get back to you on. And in addition, as we've said, feel free to reach out to Nick and to Justin. We will be providing those details as well as a recording of today's session. So thank you again, and we'll look forward to seeing you next time.
Bye for now. Thank you.